Hello there and a very warm welcome. Now, if you're a freelancer, a contractor, or you run your own small business, I'm sure this thought has crossed your mind. Can HMRC come knocking about a tax return you filed years ago? Well, it's a really good question. So, with a little help from the tax experts at My Tax Accountant, we're going to break down exactly how and why that can happen. We'll be looking at something called a discovery assessment, and more importantly, what you can do to protect yourself. Let's get right into it.
Just picture it for a moment. You've done it, you filed your self-assessment tax return. You breathe that huge sigh of relief, you shove all the paperwork into a drawer, and you get back to running your business. But then, months, or maybe even a couple of years later, a brown envelope from HMRC lands on your doormat. Honestly, that feeling in the pit of your stomach, it can really throw your whole world off balance.
But look, there is absolutely no need to panic. Knowing your rights is your best defense. So, in this guide, we're going to walk you through the whole process. We'll talk about what gives HMRC the power to take a second look, what common tripwires triggered these investigations, the really strict rules HMRC has to follow, how far back they can actually go, how you can challenge their decision, and, the most important part, your best defense to stop it from ever happening at all.
Right, let's dive into the nuts and bolts of it. When HMRC decides to reopen a tax year that you thought was completely done and dusted, they're using a very specific power. It's called a discovery assessment. So what on earth is that?
Okay, so in simple terms, a discovery assessment is basically HMRC's way of hitting the rewind button. If they find some new information or they realize an error was made that led to paying too little tax, they can use this power to issue a brand new tax bill. It's their way of saying, hold on a second, we've had another look and we think something was missed here.
Now, this is really important to get your head around. While that power sounds pretty far-reaching, the courts have actually made it very clear. Ever since the UK switched to the self-assessment system, HMRC's power to just go digging around in old tax returns has been seriously limited. They can't just reopen a case because they feel like it. They have to have a genuine discovery, and they have to meet some very strict legal conditions to do so.
Okay, so if HMRC can't just act on a whim, what is it that actually catches their attention? Let's take a look at the common red flags that can put you on their radar. That's not all. Here's where most people go wrong. So, let's make this real. Imagine a freelance graphic designer based in London. As you can see here, they might try to claim 25% of all their household bills because, one of their 4 rooms is their quote-unquote office. But if that room also has a guest bed and a TV, HMRC is going to see that as an excessive claim. Same thing with travel. If our designer travels to the same client's office in Canary Wharf 3 times a week, every week, well, that's not business travel, is it? That's a regular commute, and that's not an allowable expense. It's these kinds of small misunderstandings that can spiral into bigger problems. And here's a little pro tip for you. You need to know that HMRC uses this incredibly powerful software system called Connect. It's like a digital detective. It pulls data from everywhere, your bank accounts, the land registry, even your public social media profiles. So if your business expenses suddenly shoot up by, say, 40% one year, but your income only nudged up by 5%, that system is going to flag it instantly for a human officer to take a closer look. Consistency is your friend here, believe me. And it's not just about expenses. There are other major triggers. Forgetting to declare the income from that rental property you have, or claiming a tax relief you're not actually entitled to, these are big ones. And of course, getting involved in what HMRC deems to be an aggressive tax avoidance scheme is pretty much guaranteed to trigger a discovery assessment. Even just simple but significant inconsistencies in your books can raise a red flag. Stay with me. The next point might surprise you. Like we said, HMRC doesn't have a free pass to do whatever it wants. To issue a discovery assessment after you've already filed your return, they have to follow a very strict rulebook, which is all laid out in law. And this is the absolute key. It's not enough for them to just find a mistake. They have to be able to prove that one of 2 very specific legal conditions has been met. This is so important because it's your first line of defense if you ever need to challenge them. So what are these 2 conditions? Okay, so condition 1 is all about your behavior. HMRC has to show that the underpayment of tax happened because you, or maybe your accountant, were either careless, which means you didn't take reasonable care, or deliberate, which is more serious and means you knew you were providing wrong information. Now, condition 2 is a bit different. It says that even if you weren't careless, HMRC can still act, but only if a hypothetical competent tax officer couldn't have been reasonably expected to spot the problem based on everything you told them at the time.
So what does information made available actually mean? Well, it's not just that one tax return. It covers any extra documents you sent in, anything you told them during a previous inquiry, details from your last 2 tax returns, and, this is a good one, anything you specifically explained to them in writing, like in that white space box on the form. Basically, the more open and transparent you are, the harder it is for HMRC to later argue they couldn't have known what was going on.
This brings us to another massive question. Just how long do they have to do this? Is there a time limit on your tax affairs? Well, the answer is yes, there absolutely is, and those time limits are directly tied to the type of behavior we just talked about.
So, the law sets out 3 main time windows. The normal period for HMRC to raise a discovery assessment is 4 years from the end of the tax year in question. Now, that applies if you can show you took what's called reasonable care. If they can prove the mistake was because of careless behavior, that window gets bigger. It extends to 6 years. And in the most serious cases, things like deliberate inaccuracies or tax avoidance, they can go back a jaw-dropping 20 years.
So, 4 years. That's the standard, as long as you've acted responsibly and done your best to get it right.
6 years. That's what you're looking at if they can show there was a lack of reasonable care on your part.
But 20 years? I mean, just let that sink in for a moment. That gives them the power to look into 2 decades of your financial life. The stress and worry of that for any person or business owner is just enormous.
All right, so let's say the worst happens and that brown envelope does arrive. What do? The first rule is simple. Do not panic, and whatever you do not ignore it. Here is a clear, step-by-step plan for what to do next.
First things first, read the notice really carefully. You need to understand exactly which tax year they're looking at and why they think you owe more tax. Second, check the dates. Is the assessment even valid? Are they inside that 4, 6, or 20-year window? Third, start pulling together all your records for that period. Bank statements, receipts, everything. And fourth, and this is without a doubt the most important step, get professional advice from a tax specialist right away. This is not a DIY job.
And you have to act fast. You only have 30 days from the date on that assessment notice to officially file an appeal with HMRC. If you miss that deadline, you could lose your right to challenge their decision altogether, and that tax bill could become legally payable. The clock is ticking.
When you do appeal, you need to have solid reasons. You can argue that there was no new discovery because you'd already given them all the information they needed. You can challenge it if it's out of time. You can absolutely dispute their numbers if you think their calculations are wrong. And critically, you can argue that your actions weren't careless or deliberate, which could make the whole assessment invalid if it was sent outside that standard 4-year window.
Right, let's move on to the final and most positive section. How do you avoid this whole stressful mess in the first place? So, the crucial point is, what can you do to bulletproof your tax affairs?
Look, your best defense is always being proactive. Keep spotless financial records for all your income and expenses. Be completely open and honest in your tax returns. If there's anything unusual or complicated, use that white space notes section on the form to explain it clearly. And most importantly, if you have any doubts at all, get professional advice before you hit submit. A great accountant can spot potential red flags a mile off and make sure your return is solid from day one.
At the end of the day, it really all boils down to this: proactive compliance. Taking the time, the care, and yes, sometimes investing in professional help to get your tax return right the first time is your single best shield. It's so much less stressful and usually much less expensive than fighting an assessment years down the road.
Now, of course, we do have to make it clear that the information we've shared today is for general guidance, and it's all correct as of November 2025. Tax law is incredibly complex, and it does change, so you should never rely solely on this guide for your financial decisions.
Everybody's situation is different, so it's absolutely essential that you consult a qualified professional for advice that's tailored specifically to you and your business.
And the team at My Tax Accountant, who were brilliant in helping put this guide together, are true experts in this area. So, we'll leave you with one final question to think about. Are you confident that your past tax returns could stand up to HMRC's scrutiny? If you have even the slightest doubt, or if you've already received one of those dreaded letters, please contact the experts at My Tax Accountant for some peace of mind. You can reach them on 0208-570-8531. And for more helpful guides just like this one, make sure you subscribe to their YouTube channel. Thanks so much for watching.